Welcome to the Daily Update. This is being prepared Wednesday, March 16th, and we'll look at the action in the market today and then see how things look for St. Patrick's Day, Thursday, March 17th. And it is a crazy time right now. There is lots happening. We have, of course, the geopolitical situation between Russia and Ukraine, and that seems to be doing a little bit better, but could potentially escalate at any time. We had the president of Ukraine, Zelensky, address Congress through a virtual session on Wednesday. A lot of people are very impressed with him, and he's really calling for some help. We also had some economic reports that came out. That almost seems trite right now, but we had retail sales come out, and I'll address that. And then the big thing, at least as it influences the stock market, is the Fed meeting. And they started meeting on Tuesday. They continued their meeting on Wednesday. Then when that meeting concluded at about 2 p.m. Eastern time, they come out with an announcement of what they're going to do. And then not long after that, what's now become more of a tradition is the chairperson, in this case, Chairman Powell, or Chairperson Powell, gives a press conference. And it's really strange. When you go back in time, it used to be that they didn't even make any kind of an announcement. They might make a change to some kind of an account, and you might see something a little bit different. And well, going way back to Chairperson Volcker in the 80s, and he's the one that jacked the interest rates up very, very high in the early 1980s and tried to get inflation under control. And then after him was Chairman Greenspan, and then Bernanke. And then this has become more and more of a big deal as we go on. We live in the age of information, and we hang on their words. And sometimes things are taken in different contexts. And so we have to kind of take these things and put them together. Well, the market has to do that in real time. And sometimes they react negatively and sometimes they react positively. And we saw a really good example of a switch that took place after the announcement was made on Wednesday. So let's go back and look over what happened. We did have a gap higher open. The futures were strong during the night. There was strength coming out of Europe. There was some positive things coming out of China on an economic basis. They're still in their lockdown phase, which could feed over into the supply chain issues that we're already dealing with in the US. But at least what they said on throughout the day on Wednesday was taken as positive. And then we had a real gap higher open to start off. So things started off with a real bang. And then what is very common on the day there's going to be an announcement, for the first 60 to 90 minutes or so, the market gyrates around, whether it's going to go higher or lower. A lot of times we see kind of a flat open, but with so much happening in so many different places right now and tugging at the market in so many different directions, well, on Wednesday, we saw that gap to the upside. There was initial buying, and then everything calmed down anywhere from an hour to 90 minutes into the session, and things kind of just drifted for a while until the announcement came out. The initial reaction, right when they came out with their press statement, was negative, and the market just started to dive. In fact, it even went negative. But right after that, as you had Fed Chair Powell start to give the press conference, the markets kind of liked what they were hearing and were able to bounce back from that. And we ended up closing at the high and we're up 2.24% for the day. So think about this. In the last 2 days, we've seen over about a 4.5% gain in the S&P 500. Now, that could be quite positive. Let's fall back and look at things and see what's happening after the action on Wednesday. One thing that was positive, and probably not a surprise, is we saw above average volume So we'll go through now and we'll look at the technicals, which are turning a lot more positive after the last couple of days. We still have earnings. That'll pretty much be going until the end of March. We're still dealing with inflation almost on a daily basis as far as what way is it going. And that also influences interest rates. And then, of course, the geopolitical concerns. So what are some comments that we can make? Well, with the advance on Wednesday, the S&P is out of correction territory, the way I calculate it. We're down less than 10% now, and our technicals have more of a positive flair to them, but they're mixed overall, and I'll explain what I mean by that. We are getting a bounce out of that extreme fear reading through the CNN Money Fear and Greed Index, as can be expected. The thing is now, are we going to see that continue, or what's going to happen from here? And I have some different scenarios that I just want you to think about so that we're trying to cover as many bases as possible at the same time. But we still remain in a range. The price where the S&P is right now, we've been here before. So not a lot has really been decided on a longer term basis. We're still dealing with Russia, Ukraine, inflation, interest rates, and then the things happening in China. And that can change things and sometimes bleed over into how it impacts Europe and then ultimately the US, but not a real big player. But as things are changing in the world right now, look for China to have more and more of an influence. The economic reports that came out were retail sales, and the market liked that. And that's where we got a lot of the strength. We were seeing some strength before that report came out, but that just reinforced the strength after that report was released. And then the FOMC announcement. Those are the other really big things that happened. We continue to be overvalued. The trend overall is still negative, but with the last couple of days of going up, it is showing that that negative trend is weakening. We've dropped slightly below the moving average. So on a shorter term basis, the bias, we had another up day, that is positive. The momentum, which is maybe 2, 3, 4, 5 days, that is now positive as well. So these are just some really high level notes that I took just based on what came out of the meeting. You can get bogged down in details and semantics and how they said something in the tone of their voice and so forth. And this is all fluid too. Just because it was said today doesn't necessarily mean it's going to be the same thing that they'll say going forward. Just think of transitory and how that has changed. It turns out that at first the Fed was saying that inflation is transitory. Now it looks like it's more permanent. So this is always open to being changed, sometimes intraday even. It sounds like there's going to be about 6 more rate hikes this year. That seems possible based on what Chairman Powell said. And then as the way things stand right now, there could be 4 hikes in 2023. So this suggests that they're doing things more incrementally. They'll do it 0.25% at a time. So if you add all of that up, you can see that we're still going to be well below inflation. And so now the Fed has this balancing act between raising interest rates and slowing down inflation without doing a lot of harm to the economy. It has to twirl all of those things at the same time. It was also stated that they will probably begin reducing the balance sheet. This is the quantitative easing where they're buying bonds. And will that happen in May? It was kind of hinted that it may begin, and that's their next meeting. So we now have to wait another, 45 days or something until their next meeting. And there'll be a lot of speculation between now and then as to what's going to happen. And another thing that the markets really liked was that Chairman Powell stated that it's not likely that there will be a recession within the next year. We've been watching that. I've been talking about that. We want to keep an eye on the economic reports to see, are we seeing things really slow down? What's happening to GDP? How much can be blamed on geopolitical events? How much can be blamed on what's happening within the US economy? And that's going to be part of the debate and the tug of war that goes back and forth from here. So let's go through the day's session, look at the chart, see how people feel about things. So we're just slightly above 20 now. We were at 19. Well, after Wednesday's session, we bumped up to 22. That's still pretty extreme, but not as extreme as it could be. So at least initially, it looks like we could be getting some kind of a bounce out of after having extreme pessimism or extreme fear about things. This was also reflected in the VIX. On a closing basis, we saw a real drop. And even though we closed pretty much at the high for the bar, but on a closing basis here, we were just about at the low. So we saw a real decrease in fear as it's measured by the VIX, both on a closing basis and on the daily bar chart. The VIX of the VIX also saw a decline, both on the bar chart and on a closing basis, which could be expected when you see a huge move like we saw on Wednesday. The Ulcer Index, which as the market's going down, people get more and more stressed out about things, it flattened out a bit on Wednesday, and here is the longer term view of that chart. The sectors, some of those that really have been beaten down lately were the beneficiaries of some buying on Wednesday. Discretionary, tech, communication, materials. Some of these are value plays, some of these are growth plays. There were two sectors that were down, and these are the sectors that people have been, actually 3 sectors that were up. Hold it. Okay, there were 2 sectors that were down. The staples, that was such a small change, I thought it might be negative. Utilities saw a little bit of a downtick, and energy also saw a decline. And then just to show where things have performed since the all-time high, with energy still way in the lead and discretionary still in last place. As far as inflation, our BDI declined a little bit. So that's just showing that potentially inflation is easing off on a day in and day out basis. And we also saw a bit of a decline, not much, but a decline in the CRB, and it's been coming down from a pretty high reading. Wheat is also backing off after spiking higher. Heating oil also backing off after spiking higher. Gas also, we're seeing a real pullback right now. Well, I shouldn't say real pullback. Prices are coming off of pretty high, recent highs. The aluminum continues to be backing off after really spiking. So we're not seeing the real inflation fear right now. Now, this could change at any time. We're just seeing where the markets tend to push things to the extreme and then back off of that. Just people act that way too, where you overreact to something and then settle down and then look at things in a more straightforward manner. Okay, this is the first chart, and I'll look at these charts every day, but I may not always include them because we have all the way until the 4th of May before the next meeting. But as of right now, it is looking like there's a 67% chance that the Fed will increase rates 0.5 to 0.75%. And there's 32% saying that it could be 0.75 to a full percent. But this is going to change all the time. And then here's the new historical look back on what's happening. There's a lot of variables that are going to change this. And I may just make this go away for a while, because I don't know if we're really getting any useful analysis until we move closer to the meeting. As far as our technical alerts, man, oh man, we had a lot of them. Let me try to make this bigger and change this. I'll start at the bottom. The tech sector had a bearish, that's a death cross that happened earlier, but then the tech sector had a BPI that crossed above 20. Okay, so there was a lot of jockeying around. Materials had a BPI that crossed positive. That's above 50, as did healthcare. The financial sector had a bullish MACD crossover. And let's see, financials again had the BPI go above 30. Okay, I don't want to go through all of these individually. The S&P was able to get back above 4,300. The NASDAQ, it crossed above 13, then 13.1, 13.2, 13.3. The euro did see some strength. Now, that was a little bit strange. If we haven't been seeing the recent strength in the dollar, it would be even more strange. But usually when they raise interest rates, that makes the value of the dollar more precious and the value tends to go up. Well, we now are seeing the dollar decline and the euro advancing, even with interest rates being raised on Wednesday. So that's a little bit different than what we usually see. And then the S&P, and I'll show you this too in the chart that I have. We had a BPI that crossed above 50. So I'm not going to go through all of these. There's so much, it's almost overwhelming to look at them. But there, you can look at this overall and you see a lot more blue than red. So it was pretty good. But Canada is still having some trouble. They had a bearish MACD crossover. Okay, let's look at the chart. Here is Wednesday's session. We gapped higher and we got all the way up to S2 right off the bat. Woo! And then things danced around a little bit. And then after the open settled, we pretty much drifted. And then boom, here comes the announcement. Didn't really like that very much. Or these were people getting out of positions not too long before the announcement was made. But then we saw a little bit of a tick back up. So then here, I was incorrect. This was when the announcement came. We saw this initial drop and we set a bit of a base. Then Chairman Powell started talking and that's when the market took off. We were up 2.24%. We closed at the high and we're well into the 4,300s now. Okay, let's look at this on a bar chart. This is pretty positive, but look at where we stopped. Isn't that interesting? We got all the way up to the pivot. This is now still acting as resistance. If we can get above the pivot, that will be more positive. And that's at about 43.67 or 68. If you want to keep an eye on those prices during Thursday's session, but we stopped right up at that point. That's kind of interesting. We were able to regain some support that we had fallen through. We broke through that. It was resistance on Tuesday. Well, on Wednesday, we got above that, but now we have some other resistance and we're back into the range that we've been in. We're just doing a little bit better than we were before. We're down 9.15%. So that is just a pullback. Now, if we have a bit of a decline on Thursday, we'll go right back into correction territory. But some people like to keep track of those things. And here's the all-time high with this red line. And then we closed right at the high on Wednesday. Growth saw a real spurt where value saw a decline. And this just shows again how growth overall is still in a downtrend, but did recover. And then here is the flip-flop showing that value saw a decline, but is still in an overall uptrend. The NASDAQ 100 really outperformed the S&P, but we're still down in a downtrend overall right now. So yeah, some really cool things could be happening, but a lot of damage still needs to be repaired if things are going to get bright and shiny again. Okay, as far as our trend, this is what I'm talking about. The ADX has rolled over a bit since the red line was on top and we're seeing a decline in selling. This shows that the trend is weakening ever so slightly. And on a more positive note, we did see an increase in buying power. When this will turn the other way is when the green line crosses above the red line. But we still have a ways for that to go, for that to happen. The mass index, we're still just kind of waiting as this thing gave us a signal quite a while ago, but it's may even give us another signal here pretty soon. But so far, not really happening. The Arun, flat overall, but we're seeing a decrease in selling. But this is also measuring a decrease in buying. Kind of interesting. It's picking up this range that we're in. So it's looking back going, okay, we had a good day here, but we've been here many, many times before. So it's seeing that and not giving us any real strong readings right now. This is another potential positive, even though we're seeing the recent death cross with the S&P based on price. The praying bottom fisher gave us a recent signal. And so far, it looks like we are popping up, but we need to see some follow through for this to happen. This is incorrect. I have the PMO, at least on the intermediate term, as showing a buy signal. They didn't update this. So this is actually incorrect according to what I see. And I'll point that out. We had a healthy day as far as breadth. Based on price, we've crossed back above the moving average. We advanced based on volume, but we're still well below the moving average, and the moving average continues to roll over. The advanced decline ratio finally broke out of this little range that it had been in, popped up, and is slightly positive now. New highs and new lows, didn't really see enough because we're getting back to where we've already been. So there's really, yeah, we saw some new highs being generated, and that's always good if you're bullish on the market, but we need this to be sustained. We need to see this really advance for this trend to turn back up. And the longer term trend also continues to decline. More positive is we were able to go back above the moving average when we compare accumulation, buying, with distribution, selling. Looking at some short-term things, this is kind of cool. We finally got to see a moving average. We haven't seen one in quite a while. We were able to break above the 20-period moving average and close above that. So that's kind of cool. It's the only moving average we're really seeing right now, and it's a short-term moving average. But hey, you got to start there. Then looking at our PMO study here, let's see, our moving average study, we saw an advance based on those that were positive, and we saw an increase in the buy signals, and we're seeing those increase based on those that are above zero. And I might have this, okay, I got the wrong chart here. I was supposed to put the PMO chart, which is actually looking positive, and I messed that up somehow. Let's see if we run across it here. The MACD is positive, okay, and the STO is positive, and based on price is crossed above zero. We're still below this red line based on volume. The McClellan oscillator is showing some strength right now, and we could be getting near kind of an extreme positive reading. As with the stochastic RSI, it's already showing us an extreme positive reading after the last two up days. Williams percent R is a little more subdued here, but it is going higher and could be going into extreme positive territory if prices continue to advance. Another pretty touchy indicator is the force index. It had been pretty negative for a while. Well, it shot up positive after the last 2 days. The rate of change is also showing. We saw this after Tuesday. It was extreme. Well, it's even still extreme after Wednesday. So it just means we've gone pretty far, pretty fast on a short-term basis. Intermediate term, we still have a ways to go before we get back to the 50-period moving averages. So we're only waving hello to the 20 right now. Then, oh, here's the PMO. It showed up over here. It crossed over positive and has turned positive based on price and volume. I got something mixed up in my order, and I apologize for that. Oh, and we're seeing this again. Okay, I don't want to stop recording. I'm just going to go ahead and do this. I'm too far into this. We are now showing some kind of an extreme reading on the PMO with those that are rising. We're seeing an advance in buy signals, and we're seeing a turn up with those that are above zero. Something got mixed up in my charts. This is more positive. This is the BPI, and this is what crossed above 50. When it's above 50, that is more positive. This is the longer term chart of the BPI. Then we have a long ways to go if we're going to get back to the rainbow. So that we're seeing a real shift, and I'll point that out kind of when I go through my bullet points at the end. The stochastic, short term, positive, intermediate term, positive, longer term, turning more positive. Summation index turned up based on price and has been looking actually a little more positive based on volume. The oscillators that we look at pretty much have turned positive. What a difference 2 days makes. We were mostly negative after Tuesday. Well, after Wednesday, we're seeing almost all of these oscillators, pretty much all of them, yeah, all of them turning up right now. And we are seeing a cross in the vortex. That could potentially be positive too. The green line has moved above the red line. RSI is slightly above 50. That is positive as well. The rate of change looking back 50 periods is coming out of an extreme negative reading. The Sean trend meter, same thing, bouncing up after an extreme negative reading. The CCI, looking back 14 periods, has crossed above 0 and is rising. So that's positive. And based on 20 periods is also positive. The Chaikin oscillator, which I don't show all that often, the reason I bring this up is that we have crossed above this dotted line here, and that means things are turning more positive. Chaikin money flow, another thing I don't show all that much. It hasn't been bouncing around all that much, but it has turned positive. The ultimate oscillator, don't show that as much either. It has also crossed above 50. And then this is another one. I usually use this indicator to show overbought and oversold conditions. Well, we've been down below this midpoint on the Bollinger Band for quite a while. This is called the %B. And we're negative when we're below this. Well, we were able to get back above the midpoint, and that is turning things more positive. As far as our trading systems, the Elder system has now gone back to buy. That is a green signal, but our SAR continues to hold out and remain negative because it's seeing that we've been here before and not too long ago. Some of our different charts, the Heiken Ashi looking more positive with an open candle. Kegi also blipped up a little bit. We have a black line, which is more positive. The Renko, it took out a little bit more negative things that were showing up, but it's still, because we've been where we've been, it's not picking up the increase in prices. 3 line breaks, same thing. It's still showing us negative signs right now. Equi-volume is also showing just how we've broken up out of this range that we've been in for the last week or so. Ease of movement is positive, of course. What I look at longer period for going back 14 periods, we are going higher as well. We did have some new X's drawn into the point and figure chart, but no signal was generated. So this is positive, but it's not reading any kind of a pattern right now. Then to look at our Fibonacci, going back to a significant low that we set earlier, we were able to cross above the 50%, and we're now above that. We still have the 38.2% still above where we're at right now. Long-term charts, this is where things remain negative. Oscillators are looking good, but when you start bringing in moving averages to look at things, we have a long ways to go before we see more across the board strength. We are still below the moving average, both on the arithmetic scale and the logarithmic scale. We have to regain those, and that's right now at about 44.68. So we've got some climbing that needs to be done if we're going to get the long-term trend back under control. As long as we stay underneath that, the long-term trend is weakening. Then looking at the mega stocks, these are the big giant ones. we saw a pretty good bounce, almost 3.5% on Wednesday. And the special K, which is a longer, more stubborn oscillator that we use, it was flat on Wednesday, but continues to be negative overall. And here is the longer term view. Also, we're seeing some potential strength develop when you go back and look at the 50-period moving average. Those stocks inside the S&P that are breaking above this negative trend after giving an extreme negative reading, that is advancing. Those that are breaking above their 150-day moving average, that is advancing, and we're breaking that downtrend. And those that are breaking above their 200-day moving average, we're possibly running into some resistance right here. So we need to see some more follow through positive action for that to continue improving. Looking back 200 periods in our rate of change after giving not an extreme reading, but it had barely dropped below zero. Well, now it is starting to bounce out of that. Looking at the broad market, here is the S&P. We're kind of where we've been before with the mid caps, again, showing some real short-term strength, but we're kind of back into the mess. And small caps showing some strength, but back into the mess. So now this is kind of interesting. The FANG stocks were up over 10%. So they really advanced, but they've got a lot of work to do if they're going to get back above these moving averages. And we want to see this death cross turn into a golden cross for things to be more positive for the big tech stocks. ARK was up over 10%, really been getting hammered a lot and still is in an overall downtrend, but saw a pretty nice bounce on Wednesday. The Dow, this is potentially a little bit more positive. It was actually able to close slightly above the pivot point, but we're coming off of a death cross. So it's kind of half full, half empty. Small caps, we are coming back up to the 50-period moving average on the small caps, and that is currently acting as resistance. But we were able to get back above the pivot. And really, if you've been watching some of these videos lately, I'm really focusing on the small caps because not only in a good, healthy bull market, we want to see small caps doing really well because they tend to be more risky companies. Well, sometimes these companies can start to behave a little more positively before the bigger stocks do. And so we're kind of working with that scenario right now. And I have a chart at the very end where I will show that. Mid caps also right at the 50-period moving average. Interesting how this all seems to come together. This is why we look at things beyond just the S&P 500. NASDAQ has seen a lot more weakness, has a lot more to go if we're even to get back to the pivot level. The NASDAQ 100, same thing. If we want to see some follow through upside. Then looking at the VIXN, we closed right at the low for the session. So we've kind of broken this trend of higher highs and higher lows for fear. Well, with that advance on Wednesday, we saw a real decrease in overall fear in the NASDAQ 100. Looking at a broader index with the NYSE, we're back up into the range and we still have the pivot over where we're at. The S&P 100 did outperform the S&P 500. The Wilshire, which is another broad index, also pretty much the same thing as the NYSE. We're below the pivot and we're back into the range. Internationally, we're still showing weakness pretty much across the board, even with things positive. And as I checked right before I started recording, the futures were kind of unchanged and China was up pretty strong. But they need to really repair some things for this indicator to turn back higher. Then looking at all stocks, saw a real nice bounce over 3 1/3%, but still has a ways to go to turn back more longer term positive. Some of the broad market things we look at, we did see the dollar down 0.45%, still in an overall uptrend, both on the daily chart and in the weekly chart, but it did decline. Then looking at oil, coming off of our 130. Well, now we're down to 95. It's not crashing. It's just pulling off of a very high reading, the spike that we saw last week. Those of you, if any of you, decided to short the market, you're seeing some pretty good gains right now in the oil market. Gold is also pulling back down over 1%. It tried to break out over 2,000 and is coming back down. And here's the ETF. Even though the ETF was up 0.63%, we are seeing overall downward movement. Then here's a longer term view of the ETF as well. Silver, kind of the same thing. It's spiked up and then has fallen back, even though it had almost a 0.5% gain on Wednesday. And here's the longer term view of that ETF. Palladium spiked up, coming back down. It's really hard to see that well over 1%, almost 2%. I can't see those last two numbers on this chart. Bitcoin, it had been floundering around below 40. Well, it was finally able to break above 40. And I have to confess, I haven't checked the price since I started recording this. Bonds, this is what Chairman Powell tried to address, because we're seeing this really drop. And if it gets down here, the chances of a recession are really, really high. And he stated in his press conference that he doesn't think that will happen. But be aware of that. Sometimes these are very smart people with a lot of education and a lot of experience, but it doesn't mean that they're always right. And it doesn't mean that the way things are right now are the way things are always going to be. We're in a constantly changing environment. But as he sees things right now, he doesn't see a recession happening. So even if we drop down here, it may not lead to a recession, according to him. Now, the market may do its own interpretation of things, but that's what he is stating right now. Another thing, and I don't look at this as much, this is the 30-year bond yield. I focus more on the 10-year yield. But just because something interesting is happening, I brought this up, where if you measure the Fib retracements, we're right breaking above the 50% retracement from this high back in 2014 to the low that we set in 2020. So that just shows that interest rates could be long-term interest rates, 30-year interest rates could be breaking out. And I'll be keeping an eye on that. Here's the 10-year, which is showing that we are breaking out and we're getting back to the 61.8% retracement right now. So as to be expected, we are seeing interest rates rise overall. Then looking internationally, actually this is showing a decline for the week so far, where the 10 and the 5 are almost kissing each other again. And then we have the 2-year, and we saw a bit of a decline in the 3-month on Wednesday. Internationally, we're still seeing an advance overall with US interest rates. And pretty much all the countries now are showing positive yields. Not very high yields, but at least they're positive. Where bonds continue, even though they bounced a little bit on Wednesday, continue to be in an overall decline based on price. Corporate bonds bounced a bit on Wednesday with the advance of interest rates, and the corporate yield is now at 3.63% as of the last reading. And this is hard to get real up-to-date information on this, but it does show an overall upward trend as far as corporate bond rates. Looking at junk bonds, they recovered a bit because the stock market recovered a bit. They tend to correlate with each other. Some of our relative studies, we're still seeing this overall breakout in gold when compared to the S&P, but it is falling back. Looking at the energy sector against the S&P, also breaking out with an upward moving average, but it has been falling back recently. Then looking at growth versus the 20-year bond ETF, where we're coming up to what could be overhead resistance right now. We're coming right back up to this moving average. but it has been improving. Here is tech against the SPY. It is improving, but continues to be below the moving average. However, the moving average continues to go higher. Then looking at tech against the 10-year yield, where tech has been really underperforming, well, it bounced a bit on Wednesday. And then this is just the reverse of that chart, showing that there's a breakout in interest rates when you correlate them to the tech sector. Then looking at discretionary, which have just been getting hammered. It's in last place right now as far as our sectors, but it is showing some improvement. And then on a relative basis compared to staples, but still has a ways to go to break this overall downtrend. Then looking at the S&P against the yield, well, we saw a bit of an advance right now. And then this is the small cap thing that I've been keeping an eye on. I'm watching this base that we set right here, and this advanced a bit on Wednesday. And sometimes this can lead and go higher before we see the S&P going significantly higher. We're just waiting to see if that's one of the scenarios that will play out right now. So what is our outlook? The S&P is now out of correction territory and just back into down territory. We remain in an intermediate term range. I switched that a few days ago. We're still coming up to the end of earnings season. There's still a battle between growth and value. The economic reports coming out on Thursday are housing starts and building permits. That can sometimes have an influence. We have initial and continuing weekly jobless claims. Industrial production and capacity utilization can also have an influence, and the Philadelphia Fed index. So lots of more reports that are coming out. And then the geopolitical events. There may be some follow-through reaction to the FOMC meeting. Sometimes people don't really make decisions until they get home from work and they're studying things and they log into their brokerage account and then they decide, okay, Thursday, this is what I want to do. I want to buy or I want to sell. So there may be some more follow-through reaction that can come from that. And then the lockdowns, again, are what is happening now in China, which may feed over into the supply chain concerns that we've been having. Then these are just some different scenarios, and these will change all the time. In my classes, I like to teach, be prepared for everything at the same time, whether it goes against what you think or feel, whether it goes against your opinions or for your opinions. That's how you lose in the market, is when you take your opinions and your preconceived notions and then apply them to the market. What we need to do is have an open mind and be flexible to the point where, okay, we may agree or disagree. That doesn't matter right now. What is price doing? You may be looking at a chart saying it should be going up when it's actually going down. That doesn't matter. You have to follow price. So I'm trying to throw different scenarios to you just to have you thinking about different things. Some of these may turn out to be true. Some of them may fall off. Some of them may be replaced with other scenarios. But one thing is, we had a big reaction the last couple of days. And what has happened historically, you go back to Katrina, you go back to Brexit, you go back to the 2016 election. When the market really reacts in a short period of time, you go back to COVID even. That's probably the best example. What was the trend doing before that happened? We were in an uptrend before COVID hit. Everything went all crazy. We went down, end of the world, Armageddon, and the whole bit. Well, once that got over, we reverted back to the previous trend and we went up. Okay, so what was the trend before the Fed announcement on Wednesday? It was negative. Are we going to return to that negative trend? Okay, historically, that is what has happened. And the bounce that we're seeing right now, is that just to wear off some of the extreme pessimism that we've been seeing? Seeing a lot of fear, seeing an increase in the VIX, seeing a lot of real negative things right now. What if we have a few up days and then maybe some sideways days where we kind of wear off that extreme negative reading and then get set to go lower again? That could happen. Okay, we've got a lot of really strange things happening in the world right now, and depending on what happens, the market may take those as positive or it can take those as negative. Another scenario is, and I've been talking about this for a few days, is are we seeing a possible base forming where we're going sideways? We haven't really broke any real long-term support, at least yet. We're showing extreme negative readings, and now we're starting to bounce up out of that, where our oscillators have turned positive, but we have not regained our moving averages right now. The first thing is we really want to get back above the 200 moving averages, both the exponential and the simple. That's what's going to affect the long-term trend. But right now we're back above the 20. Can we get back above the 50? Can we get back above the 100? Then eventually, can we get back above the 200? Those are the things that we need to be watching for, not only in the S&P, but in other indexes as well. So what is our conclusion? The S&P is mixed and in a range. The reason I say mixed is the oscillators are positive and the moving averages, we're still below them based on price. Now, if you use oscillators more to make decisions, things are looking more positive. If you use moving averages to make decisions, you're probably still kind of negative, okay? The short-term bias is positive. Intermediate term bias is positive to mixed because the oscillators are positive and we're still below the moving averages. Those are still negative. The long-term bias, even with the last couple of days, as long as we stay below those longer-term moving averages, things are not improving on a long-term basis. And then the different scenarios that I just pointed out here, just be aware of those things. And please, in the comments, or if you want to send me an email, let me know what are some different scenarios that you're looking at. What are some things that I might be overlooking or that I'm not mentioning that I probably should mention? Let me know what you think. So thank you very much. I hope you have a wonderful Thursday and a wonderful St. Patrick's Day. The luck of the Irish to you. That's my background, my ancestral background. So enjoy the day, and I will talk to you again at the close of Thursday's session.